Today, household financial confidence erodes some more. Hello again, it's Martin North from Digital Finance Analytics, writing the latest post covering finance and property news with a distinctively Australian flavour. Well, the bad news keeps coming, with the latest DFA Household Financial Confidence Index for October at the lowest ever level of 83.7. This continues the trends of recent months, since dropping through the neutral 100 score in June 2017. The falls were widespread across our property segments, with investors still way down under the pressure from low net rental yields, the need to switch to principal interest from interest only, and worries about construction defects. Owner-occupied households were less negative, but those renting continued to struggle with higher levels of rental stress. Across the states, there were significant falls in New South Wales and Victoria, whilst other states continue to track as in recent months. The main eastern states now are lower than Western Australia and South Australia, which is a surprising new development. Across the age bands, the falls are mainly among lower age groups, while those aged 50 to 60 are feeling more positive thanks to recent stock market rises. And this is also reflected across our wealth segments, with those holding property mortgage-free and other financial assets more positive, although still below neutral, compared with mortgage holders and those not holding property at all. We can then turn to look at the moving parts within our index based on our rolling 52,000 household surveys. Employment prospects continue to look shaky, both in terms of underemployment and job security. Jobs in retail and construction and also finance are under pressure, and the impact of the drought is also hitting some areas hard. 8% of households felt more secure than a year ago, and that's the lowest read ever seen in this part of the survey. More households have multiple part-time jobs, and incomes remain under pressure, with 51% saying their real incomes have fallen in the past year, while 5% reported an increase, often thanks to switching jobs or employers. Household budgets are under pressure as costs of living rise, with 91% reporting higher real costs than a year ago, and that's a record in our survey. Expenses rose across the board from childcare, healthcare, school fees, and rates, and food costs were higher, partly thanks to the drought. There was a small fall in the cost of power and fuel, but not enough to offset rises elsewhere. And mortgage interest rate falls were blotted up quickly, and the tax refunds, where they were received, were much lower than people were expecting. Some households are deleveraging or paying down debt, while others are more concerned about the amount they owe, from mortgages to credit cards and on other forms of credit. 48% of households are less comfortable than a year ago. Lower interest rates are only helping at the margin. Savings are under pressure from several fronts. Some households are tapping into savings to keep the household budget in check, but that will not be sustainable. Others are seeing returns on term deposits falling away, yet are unwilling to move into higher risk investment assets. Those in share markets are enjoying the current bounce, but many express concerns about its sustainability. 49% of households are less comfortable than a year ago, while 47% are about the same. Significantly, around 27% of households have no savings at all and would have difficulty in pulling $500 together in an emergency. And around half of those households are also holding a mortgage. And it's worth reflecting on this, with 32.2% of households in mortgage stress, as we also reported today. And finally, we consider net worth, assets less liabilities. Here, the news is mixed, as some households are now convinced their property is worth more, citing the recently, if narrowly sourced, data on rises in Sydney and Melbourne. However, other households reported net falls. 24% of households said their net financial position was better than a year ago. That's up 1.3% on last month, while 45% said that they were worse off, down 1.6% from last month. There are also significant regional differences, with households in Western Australia and Queensland significantly worse off, while some in inner city areas of Sydney and Melbourne claimed significant advances. So overall, the status of household financial confidence continues to weaken, which is consistent with reduced retail activity and a focus on repaying debt. Unemployment is lurking, but underemployment is real. We also see weaker demand for mortgages ahead, and we'll discuss this in more detail in our upcoming household survey release. Without significant economic change, these trends are likely to continue for some time, and if the RBA and government is relying on households to start spending, they will need a very different strategy, including a significant fiscal element. Because lower interest rates alone just will not cut the mustard. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.